Yeah, and this is definitely, so let's talk about what I would say is like the newest source of funds, which is loans from third parties, right? It's a well-established principle that you could have borrowed from an institution at any point for EB5. It's written into the statute. Debt has always been recognized as an appropriate instrument for an EB5 investment, meaning you could go to a bank, you could get a loan, and you can now use that money to do your source of fund, to do your, sorry, your EB5 investment. Okay, but Zhang v. USCIS, which is a case that came about a few years ago, this really set the precedent for, okay, well, what happens when you go to someone who, has money and is willing to give you a personal loan, secured or unsecured, and you use that now money for your EB5 investment. And a judge and the court really said that's actually okay, right? It's not USCIS's place to understand the purpose or the thinking behind a creditor providing a loan to a debtor, okay? Their job is really just to make sure that the money that is now arriving in USCIS's account, or sorry, into the project's account, is credible and lawfully sourced. And this changed the standard. What this basically said was, okay, it's now okay to go out and get a loan from a family member, a friend, or an unsecured loan from a family member or friend, and basically use that money for your EB5 investment. But it comes with a caveat, right? We're no longer looking at kind of why the loan is given to you, but we are still going to look at where that money came from and how that money was sourced. Okay, so this is going to kind of speak back to what we were talking about when we were talking about a gift or an inheritance. You can absolutely get a personal loan from a non-institution, non-financial institution, right? So this could be a friend, maybe an employer. We've seen family members who are distant relatives who happen to be very wealthy and are willing to provide a short-term loan, 5-6 years, so you can do your EB5 investment. That's fine. What you're still going to have to show is, if it's collateralized, you're going to have to get the fair market value of the collateral, right? So let's say you've got an uncle who says, hey, look, I know you're trying to do this EB5 thing. You've got this house. Instead of taking a HELOC and maybe paying a higher interest rate, I'll give you a loan, pay me a lower interest rate. That's okay, all right? So you want to be able to show the same documents that you would normally show to a bank for the HELOC. You're going to show that valuation, you're going to show that property, you're going to show that it's worth a certain amount of money, and then you're going to have a memorialized agreement with your uncle showing the funds that are being loaned to you, right? So you're going to have to go through that same analysis that we talked about when we talked about real property. You're going to have to show how you purchased that property, how the value has grown, what it's worth now. And then in addition to that, once your uncle loans you the funds, he also has to show where did that money come from, right? He's providing a legitimate loan to you, maybe at better financial terms, and that's totally okay, but he's gonna have to show where that money came from, okay? The other way that, that you can look at this also is, what if you do go to an institution, but you get an uncollateralized loan, basically what we call an unsecured loan? This is actually okay as well. In the current lending environment, it may not be very easy to do, but it is certainly feasible if you're a high earner. Let's say maybe you're a doctor, you've been earning money for several years, you've got a pretty nice stream of income that's, not guaranteed, but certainly a safer bet than a lot of other occupations. Banks may still look to your net worth, and maybe you've got a personal relationship with a local bank and say, hey, you know what? I know you're good for this. Here's $200,000 that I'm willing to give to you as an unsecured loan, okay? And that's actually totally okay, right? You can actually take that loan and say, thank you so much, bank. And the loan agreement is memorialized. It's a financial institution, so you don't actually have to source that capital, and you're all good to go. The third variation of this, I think, is where we kind of come into, which is the one that's probably the most interesting, which is when you get an unsecured loan from a non-institution, right? So a non-financial institution. And this is basically where you go to a friend and you say, hey, man, I'm so close. I've got 600,000. I need $200,000 more to do this EB5 thing. It would help my family out a lot if I could just somehow find a way to do this. And that friend, he's got money. He says, hey, you know what? I've got 200K. I think you're good to pay it back. I'm going to charge you a little bit of interest, but I'm happy to give you this loan because I've known you for a long period of time. Look, this is totally okay in the EB-5 context, okay? You do have to do it the right way, and the right way means sourcing that friend's capital all the way, right? So if let's say they're taking out a HELOC, they're a really good friend, and they're willing to mortgage their house or basically take out a line of credit against their house to give you money, that's fine, but now you have to go back and show how they were able to purchase that house, that they own the house, and that house has a certain amount of value that basically is in line with how much money they're taking out as a loan. Okay, so all three of these scenarios that I just walked us through, these are totally okay. You just have to worry about, okay, if there's collateral attached, I want to make sure I'm showing ownership of that collateral, how, whoever the donor is came into possession of that collateral, or if it's my collateral, how I came into possession of it, and the valuation as well of that same collateral. If it's someone who's giving you money, that's not an institution, you want to make sure that they're sourcing their funds all the way back to where it first came to them, either through employment income, ordinary income, or if it came from an institution, if they're taking out a loan to help you or something like that. All that's very, very important. So I think the big takeaway from loans from third parties is, look, it's very doable, but this is really where people can get tripped up. This is definitely the place where people have the most problems because they've got part of the problem figured out where they've got the money now, but they didn't take the time to go through and source that capital properly for USCIS to see that it's lawfully sourced.